Earlier this year, FIS and Bank Director partnered together on the 2014 Risk Practices Survey, with the goal to uncover risk oversight and risk management best practices that create high-performance banking. I wanted to highlight 5 groundbreaking findings and share some best practices to take away. The first groundbreaking finding is that regardless of asset size, those banks that use a separate board risk committee for risk oversight perform better financially and have a higher median ROE and ROA than those that use an audit committee or a combined audit and risk committee. Even banks with a combined audit and risk committee have a higher median ROE and ROA than those that use the audit committee for risk oversight. So the best practice takeaway is that regardless of your asset size, you should establish a separate board risk committee to oversee risk and also appoint a qualified chief risk officer to manage those risks. Enhancing risk governance will positively impact financial performance. The next finding is a surprise on several fronts. The majority of respondents, regardless of asset size, have formulated a separate board risk committee. Over 3/4 of the respondents, between 5 and 10 billion in asset size, and over half that are less than 5 billion, use a separate board risk committee, even though they do not have to by law. So the good news is that the trend, regardless of asset size, is to formulate a separate board risk committee to enhance risk governance. However, the bad news is that while most risk committees perform duties such as reviewing the enterprise risk assessment, compliance with risk management programs, policies and procedures, and approving risk policies, over 1/3 do not yet review the strategic plan and risk mitigation strategies. So the best practice takeaway is that if you have a separate risk committee, you should make sure the committee also reviews the strategic plan and risk mitigation strategies, in addition to the other duties. This will enable you to link strategy with risk and enable the risk committee to deliver maximum value and enhance risk governance. The third finding is that while 3/4 of respondents have established a risk appetite statement, the majority do not use it to provide limits for board and management and only use it as a guide, with only 13% using it to analyze how it impacted the bank's performance and strategic objectives. So the best practice takeaway is to implement a risk appetite statement that covers all risks faced by the bank and to make sure you use it to provide limits for board and management and not just a guide. Otherwise, it'll just be a paper tiger. Also, use it to analyze how it impacted the bank's performance. Fully utilizing the risk appetite statement will enable attaining strategic objectives while avoiding adverse impact to earnings, capital, or reputation. The fourth finding is that more than 1/4 of banks have not yet established a risk dashboard. While the majority of these institutions use the risk dashboard to make adjustments to strategy or risk mitigation, monitor risk tolerances and limits, identify emerging risks, about 1/3 do not yet use it to evaluate bank performance. Can one drive a car or fly an airplane without a dashboard? Similarly, can one run a bank effectively without a risk dashboard? The answer is no, one cannot. So the best practice takeaway is that if you have not yet, you should implement a risk dashboard for both the board and executive management. This will provide the data and metrics needed to evaluate bank performance, especially whether risk management enabled attaining strategic objectives while avoiding adverse impact to earnings, capital, or reputation. The final finding that I wanted to highlight is that just 17% of respondents review the bank's risk profile and related metrics at the board and executive management level on a monthly basis. About half of the respondents review the metrics quarterly, and about 1/4 do so twice a year or annually, with 11% of banks not reviewing them at all. So the best practice takeaway is to have the risk committee of the board and executive management review the bank's risk profile and key metrics monthly. This enables timely adjustments to strategy and risk management and greater assurance that strategic objectives will be met and surprises avoided. Effective risk oversight and risk management is all about looking forward. The key to success is to focus on emerging risks and preventing issues from becoming a barrier to meeting strategic objectives or causing a surprise and adverse impact to earnings, capital, or reputation. One cannot be successful unless one focuses on key risk indicators, trends, and changes to the risk profile, so risk mitigation can happen before it is too late. In summary, the FIS and Bank Director 2014 Risk Practices Survey uncovered several groundbreaking findings, especially the 5 risk oversight best practices that create high-performance banking. We hope you implement these best practices and take your bank to the next level of performance.